here is the gas prices at the pump in the US. We could use nat gas in Europe. There's a bunch of these things that are exploded. Food prices exploded. And what that means that these consumers have had to pay a tax. Their discretionary income has been more used now for the basic goods and services that they've needed. We've seen this in the past when healthcare costs exploded or schooling costs exploded. Both of those are moderated in recent years. But this is a shock that means people spend less on other stuff. We've seen stuff like restaurants rolling over because of stuff like this. The question is also, does demand destruction start destroying the demand for commodities? I wanted to understand demand destruction, whether it can change the price of oil as well. Could this be the thing that saves the markets from this hugely tight supply is lowering demand? Does that cause a big pause in the commodity rally or even a decent size reversal? I'm looking at the chart of oil and I don't know which way it goes, but it's looking to me that this is the GMI crash pattern. And the GMI crash pattern is it makes a peak, it then kind of messes around a bit, it creates a floor. When it breaks that floor, price accelerates lower. If that is the case, then again, it's going to add to my story that inflation is going to moderate because of demand destruction, and that the global economy is slowing faster, and it's going to change some of the equation. Now, it may not change the food equation because food is a basic good. You demand less. Demand is inelastic. So we need to wait and see what happens with the summer and the planting season and all of that. So here's a chart that I stole from somebody else, which from Alpine Macro. And what they did is constructed a growth tax. This is based on the dollar, oil price and interest rates. And they look at it versus ISM. Now, this is really concerning. And this is the point I've been trying to get across to people. I've been explaining it on Twitter. I've been explaining it in Real Vision Pro Macro and Macro Insiders, is that it's suggesting that the ISM really could collapse. This one's saying it goes to 42, which is a full and decent sized recession. Now, these data series are volatile. It doesn't always go tick for tick, as you can see on the chart. It gives you the general direction, and that the probability of crossing 50 is pretty high right now. So I would take that seriously and concerningly, that the forward-looking growth is going to decelerate so rapidly that people are not prepared for it yet. And we've seen this in China. So the next chart here is the Chinese credit impulse. Chinese credit impulse has led the world economy for a while because China's a huge part of the global economy. Now we know that China's been tightening credit, and what we saw is a recession essentially in China. Now, Chinese never report negative numbers, but we've got essentially a recession in China, and they're starting to stimulate now, but it leads the world by 12 months. And the Chinese economy suggests we're going to get a full recession in the US. This maps to the global PMI too. Europe is pretty close to recession already. The German forward-looking indicators are suggesting that, and that is again driven by demand destruction of the higher inflation. We're also in Europe likely to see some sort of controls over the use of energy as they struggle with this shift of energy use into away from Russia into other areas. They're going to have this very high period of prices, and I think we're going to see demand destruction and forced demand destruction by shuttering or rationing some of the energy supply to some of the manufacturers. I mean, these are the extremities of the time, but when you've got war on your doorstep, the Europeans of all people understand the sacrifice that needs to be made. So I think that is something, I'll talk a bit more about the sacrifices in Europe in due course when it comes to stimulus, which I think is the net outcome as ever. Now, when I look at other forward-looking data, I use the ECRI. We have Lakshman a lot on Real Vision, and he's my business cycle expert. The ECRI, the Economic Cycles Research Institute, their weekly indicator year on year has been falling very sharply and has come to very moderated levels, and is following pretty much what I'm saying now, that I worry that if it starts to cross zero, then we're getting close to a contractionary phase. It's not there yet, but the warning signs are coming because of the speed of the decline. The only good sign is if I just take the index itself, not the year on year, it's not declining, it's been going sideways. And that suggests that maybe we avoid the recession. Maybe what we've got is a growth shock. Now, growth shocks are really normal after recessions. We get the big whoosh after the recession. The fiscal stimulus comes through, it all comes through, then the fiscal stimulus fades off, and what we tend to see is growth come back down again. We tend to see the central banks stopping trying to tighten and stuff like that, and I'll come on to that later. And then the economy recovers. It kind of, people fear a second double dip recession, and it doesn't happen. That's still kind of my base case. I'm not sure because it's really close, but this equity not going down suggests that maybe we hit stability. Even if we get to zero GDP growth, maybe we don't go anything lower. But let's see. It's all to play out probably in the next 6 months. So this is not going to be an instant fix here. We'll see this growth coming through in the next few months, I think. Now, talking about demand destruction, you can see it writ large here. This is residential fixed investment as a percentage of total fixed investment. What it's saying is households have stopped spending on their own houses. Now, most of us in the pandemic spent a fortune on doing up our houses because we were stuck at home and we realized our sofa was crappy and we wanted a Peloton and all the other stuff that we all did, build a new deck and all of that stuff. And that brought us a huge spike in residential fixed investment, which basically forward-led the rise in ISM. That is coming off fast, and we're back down to that 50 level in ISM. That's very consistent in my forward-looking charts. And I think it's important to note that this is, that I'm not plucking a few charts here. There's a lot of forward-looking indicators suggesting this. The other issue is the US and most countries are economies of small businesses. These small businesses got killed by the pandemic, but then luckily tax breaks helped them. Now the tax breaks have gone and they've got rising prices and they're picking up that the consumer is not in the shape they were. And now we can see that small business optimism is starting to fade while ISM is still high. Usually ISM should follow suit over time. So I'm expecting ISM to come down, and I think small business optimism will continue to go lower as well. Something worth watching. But the picture's even more concerning when I look at household sentiment. So households are terrified right now. They're the most terrified they've been since 2008. And I can understand why. You've raised the cost of everything. You've taken away the fiscal stimulus, and people just don't know whether they can cope with this situation. I mean, don't forget, household disposable income in the US, there may be a lot of assets, but people live paycheck to paycheck. They live on credit, and we've seen credit going up and savings going down to try and counteract these high prices. These high prices are extremely recessionary on the consumer, and I think we're going to see more and more of this. And it also happens globally. That same discretionary spending pattern is happening across the world. It's not just the US. You've got these aging population, and older people have fixed incomes, i.e. they've retired, they've got a pension. You raise the cost of living on them, it kills them. And I think this is not something most people are factoring in, is the demographic composition, the debt composition, and then adding higher prices is extraordinarily difficult.
If you enjoyed this video, make sure to leave a like, comment, and subscribe. We'll see you in the next video for more finance tips and up-to-date news.